Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission?
To spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another exciting episode of the What Matters podcast, where we explore the world of finance and beyond. I'm your host, Mike Mershazadeh. And today we're honored to have Anders Jones, the co-founder and CEO of Facet Wealth, based in Baltimore, Maryland. I apologize about that, joining us.
Hey, great to be here. So I'll give you a little bit of my personal history because it's all part of the story. But, I grew up in Boston, went to Stanford University, and graduated in 2000. So with the exception of 2020, probably like the worst possible year to graduate from college in recent history. I think 75% of my class graduated without a job. And so I'm out there in Silicon Valley. What do? There's no jobs to be had. You do a startup. So I joined the early team of a company that eventually became known as LiveRamp in the advertising technology space. I think it was like the 8th employee there or something like that. And learned a ton about early company building and basically building technology. We sold that in 2014 to Acxiom. Subsequently got spun out as a public company. So, it's now listed in the New York Stock Exchange. So it was a great, incredible, like early stage or early career learning experience. And then from there, one of the board members of LiveRamp, a guy named Patrick McKenna, he and I and worked together fairly closely, over the course of my time there. And we had said, hey, let's keep working together. Let's, invest together, and let's see if we can identify an opportunity to build like a really, game-changing company in a space that's like a massive market that we could build like a real sort of standalone company. So this was in 2014, 2015 timeframe. And we got very interested in what was going on in fintech and wealth tech. This was right around the time when the first set of robo-advisors were getting a lot of attention. So like the wealth funds and betterments of the world. And we were sort of looking at those and we just couldn't quite figure out how are the unit economics of these businesses working. This is like everyone was concerned that this is going to be the end of the human advisor. And that didn't seem quite right either. And then the big aha moment we had was when the DOL fiduciary came out. And this was the sort of rule that said, if you're a financial advisor, you're not legally obligated to act in your client's best interest. And that didn't pass, which is like a mind-blowing turn of events. And the pushback was, well, if you do this, you're going to end up with 8 million clients that lose their advisor relationship because they can't afford to act in their advisor's best interest, in their client's best interest and service them at the same time, which is just like a very like sort of wild thing that the industry is like publicly admitting that they're screwing 8 million clients. And so that was really the genesis where I was like, well, wait a second, there's actually a huge cost structure problem in this industry. Financial advice is very expensive to deliver. Our high quality financial advice is very expensive to deliver. We also then, as outsiders, came in and sort of said, what are some of the other big assumptions in the wealth management industry that might not actually, like, from a purely first principle standpoint, might not actually be true? The AUM-based fee model was another one that we looked at and said, this just doesn't make sense. You are not paying for advice in the same way that you're receiving value from advice. And what I mean by that, and we can talk about that, but what I mean by that is like, you're paying for basically expert help, like the same way that you pay for a lawyer or an accountant. Like you're basically paying for someone's time and expertise. The AUM-based model, you're basically paying for someone to beat the market. And I would say if you're an average retail investor, if an advisor comes to you and says, I'm going to help you beat the market, you should run the other way. And so it's a very misaligned incentive system. And in an efficient market, like that doesn't, those misalignments don't last forever. Right? And I honestly believe that in the next 5 to 10 years, the vast majority of financial advice in the retail segment, anyways, will be a subscription or flat fee. There's a lot of ways to get there, but it will be less and less about flat fee subscription. So, anyways, that's the long-winded version of sort of the founding story. And then we started Facet basically said, let's build a direct-to-consumer fintech company that does subscription-based financial planning that's lower cost and higher quality. And let's focus on the mass affluent market because that's the most underserved, massive market that's out there. No one has figured out how to work with, but they all desperately need help and advice, and that's what we did.
So tell us a little bit about that, right? So, you and I can say that the information we receive is not always correct. So you can correct us on this one. Your AUM is around 3 billion today. Is that correct?
Yeah, that's right.
Yeah. You know what? When I looked at it, it said like 2.2 billion. So I figured, they're always about 25% off because they're not dated as of today. We're not like, digging on current data. So tell us how you got there. How did you build the company to 3 billion? Did you do it organically, inorganically? Can you share a little bit about that?
Totally. And I think as a starting point, we really don't track our AUM. And actually, honestly, the only reason I know it's 3 billion is because it's like a billion milestone, which is like, somewhat important to know. But we don't require our clients to manage money with us. And so I think everyone else in the industry is so focused on AUM because that's how they charge and that's where the revenue base comes from. We think about it in terms of what's the number of households that we service, and then we charge a flat annual subscription for the financial planning that we provide. If someone wants to manage money with us, we have a great offering. We do it for free as part of the Facet membership. So I think we manage money for like 75% of our clients at this point. Anyways, I just think it's another sort of unique thing about us that we don't count, we don't sort of consider AUM to be success in the same way that the rest of the industry does. And sorry, your question is about how we did it.
Yeah.
I mean, I try to condense 8 years down to 2.5 minutes, but it's I think at the highest level, we started out by basically saying, we want to create a lower cost, higher quality offering for an underserved market. And so we went in a direction that I think most other advisors haven't gone, and basically said, we want to actually be able to charge as little as possible and still make money. Because there's a much bigger market out there that we can basically play the volume game, play the sort of next market game, and that's basically what we what we did. So our sort of core value prop is you work with a dedicated CFP. These are W-2 employees of Facet, so it's not like a mix and match marketplace or platform like that. They're Facet employees. They follow the Facet philosophy and planning process. You pay a flat annual subscription. Ranges anywhere from $2,000 to $6,000 a year. It's really tied to the complexity of your situation, and so you know exactly what you're paying for, exactly what you're getting. And then we look at sort of like everything in life that money touches. So this is another problem we identified with the vast majority of financial planning is that it's really focused on retirement planning and asset allocation. And yeah, there's two important things, but it's a tiny slice of the potential breadth that financial planning can actually cover. And we found that there's a way to give people value today and sort of peace of mind, a better life today by looking at a much broader set of topics. So we actually help people with 44 different life milestones: buying a house, getting married, having a kid, taking care of your aging parents, whatever it might be. And so it's a much more sort of holistic offering. So we put that value prop together, and then we've grown 100% organically. We haven't done any inorganic growth, and we basically built a consumer brand. And I think the interesting thing about our client base is 80% of them have never worked with a financial advisor before. So our approach to customer acquisition is very different than a traditional advisor. We're actually not really competing with anyone. I mean, that's not true. Obviously, it's a huge market. There's a lot of competition. But in the sales process, we're very rarely selling against people or another firm. Instead, we're playing an education game. Right? People are like, why do I even need financial planning? Like, what even is this thing? And so we take a much more educational approach around financial planning and customer acquisition. And so there's like a long tail sort of nurture campaign that we bring people through to help them understand, like, okay, you are facing this specific life milestone. Let us help you think about how to, the financial planning implications of that. And then from there we can sort of expand beyond that. So that's been yeah.
Oh, I was going to say, and don't mind, I always like to take notes when we're on the call. So,
Yep.
If I'm looking away, it's not because I'm not listening to you. I'm just jotting down interesting things that you're saying.
Totally. Yeah. So, that's at the high level, sort of how we've approached the playbook. There's a lot of science behind that, but that's kind of how we've thought about it. And, we've had a pretty strong growth trajectory. For context, we went into COVID at about $2 million revenue. Right now we're sitting at about $40 million. So It's been a pretty fast growth trajectory the last few years.
When you guys went into COVID, how big, what was the size of your AUM back then?
Probably 500-600 million, maybe.
Wow. So you guys have basically, 6x'd in size in the last 3-4 years.
Well, again, I think about it in terms of revenue. So
right.
By that measure, we've 20x'd.
Right. Wow. That is so interesting. And talk a little bit about that. Was that just bringing on new clients? Offering more products?
Yeah. It's been largely almost entirely new client growth. We've experimented a little bit with our pricing and done some optimizations around the pricing. We simplified it down. Like at one point we had, I think, 12 different pricing tiers, and we've simplified it down now to 3. And so our average revenue has ticked up. We're talking going from 2,000 to 3,000, 2,000 to 10,000. So it's really largely come from almost entirely new client growth.
Wow, that's remarkable. And do you guys do you guys have advisors? You said you're heavily tech based. Do you guys have advisors, or is it how do you run your system there?
Yeah, so we have about 70 CFPs, and our belief is that human-based financial advice isn't going away anytime soon. But the way we think about it is that an advisor's highest and best use is time spent with a client, helping them understand like the ins and outs of the more sort of subjective and qualitative aspects of their financial life. It's very difficult to sort of replace that human-to-human interaction, understanding, and sort of like the emotional components of your financial life. Everything else should be automated. So, two big things. One is we have a totally separate sales team from planning team. So we don't ask our advisors to sell. We have a totally separate team that actually manages the onboarding. When an advisor first talks to a client, like the first interaction they have with a new client, that person has already gone through a sales process. They've already uploaded all of their data. They've already onboarded. And so like conversation number one can be a very high value targeted conversation around their financial life, what they want to get out of their relationship with us. The other thing we've done is we've built a lot of tech on the back end to make our advisors a lot more efficient and to enable that sort of, human to human interaction and only that. So we have a totally proprietary financial planning tool, financial planning platform, I should say. The average advisor for us works with about 300 clients versus an industry average of about 75. So we've essentially 4x their productivity, which is really the key to sort of the cost structure and ability to offer a lower cost service.
And to bring business in, is it just word of mouth with you guys, or how's the advertisement going? How do you guys advertise to bring in new clients?
Yeah, so we have a pretty robust like digital demand generation platform. So, it's sort of every trick you might imagine, every tactic you might imagine from it's sort of like consumer digital playbook. So we have, sort of the affiliates, we have, search, we have social, we have, very heavy content-based program. We have a bunch of proprietary assets, like we have a financial wellness quiz or a money mindset quiz that sort of gets people engaged in thinking about how they're, where do they rank skills or financially stable are they? And then, we've also done some interesting stuff that I think is like relatively new in the industry. The SEC just dropped the testimonial rule not so long ago. So now you can actually, advisors can use testimonials to acquire clients. So we've actually built like a whole influencer program. So we work with a bunch of the top personal finance influencers on social media. It pains me to say it a little bit, but like we're, a pretty big TikTok presence. And we have like a pretty robust community of folks that are out there sort of creating their own content, but in partnership with Facet. And it's been a big driver of growth as well.
So you guys, a lot of social media that you guys use to drive in clients. That's really cool.
Mm-hmm.
Do you do a lot of the I'll call them cameos yourself or videos yourself there, or
No, I definitely do not. I'm not a financial advisor. I'm definitely not camera ready.
I think you're doing great on camera.
Yeah, well, we'll see what your audience thinks, but my co-founder Brent Weiss is a CFP. He does a lot of that. We also, like I said, have partnerships with a bunch of other sort of personal finance gurus like Ramit Sethi. He had a Netflix show on personal finance. He's a big partner of ours. We've done some interesting experiments with folks that are sort of like tangential to in the wellness space. So like Jess Sims from Peloton, we've worked with her before. So we have a cool set of folks that are kind of at the table on this.
Wow. So tell me about this this capital raise. I know you guys have been instrumental in raising over 200 million. As you probably read in most recent news, we've just undergone a pretty big capital raise ourselves. And so I know exactly what that's like. Can you walk us through your approach in fundraising and strategies you've employed to secure the investment for your organization?
Yeah, I'd say we got very lucky very early on. So we work with Warburg Pincus as our primary investor, and they actually we started working with them when we were basically pre-revenue. And so, for those of you who don't know Warburg Pincus, they're a large sort of global growth equity firm. They typically write like $300 million checks and like buy businesses outright. So for them to write, at the time it was a $30 million check Series A in 2018, which was a big check for us, but a tiny check for them. It was a very odd deal for them to do, and frankly for us to do also. But they have a long history of investing in financial services, and specifically in sort of like mass affluent financial advice companies. Like they were a big owner of the mutual fund store of Financial Engines. They now own Element Financial Engines outright. So they know what they're doing, and they had basically built a thesis in this space around sort of the future of financial planning for the mass affluent. And it matched up exactly with what we were building and what we've built. And so when we first met, it was sort of like a meeting of the minds, and it was a pretty easy conversation to say like, yeah, we should work together. And I really give them a lot of credit. I mean, we are so outside of the scope of where they typically play. And when you're a startup and you have you're starting from scratch, like the sort of the roller coaster adventure is a lot more volatile than a more established company. They've been great to work with. So they're sort of our primary backer. They're still a minority shareholder. So the founding team still has control, which is nice. And then we did a Series C in I guess end of 2021, brought in Durable Capital Partners, who's more of a public focused firm, but they have a small set of private investments. And so, we've been very lucky. Our cap table's got some pretty heavy hitters on there, and they've been great partners.
Really cool.
Oh man, I mean, there's so many lessons learned, and we're now 8 years into the journey. It's like every day I wake up and think, man, I wish I hadn't done that. I wish I had done that, 4 years ago, or whatever it was. So there's a lot of learnings there. I mean, if I had to distill it down into like a few tidbits, I'd say um, one of the best things I think that served us well is that we were outsiders coming in and basically sort of questioning every assumption, but also approaching it from a very humble place where it's like, we don't know what we don't know. We disagree with certain aspects of this industry and how the industry is built, but also it's a very successful industry. And so therefore we shouldn't like throw the baby out with the bathwater. And so I think having a like, very sort of like first principles approach and level of curiosity, but also not, understanding where like if something's working, don't change it for the sake of changing it. That's one. I mean, I think sort of the old chestnut that is always a go-to is that be very thoughtful about who you bring onto the team, and be slow to hire and quick to fire. We have by and large a fantastic team, and I feel like I've always been very lucky about the folks that we've brought on board, and the people that are supporting me. I mean, this is my first gig as CEO. I'm 36 years old. Every day I wake up in the biggest job of my life. I have a much more experienced and seasoned executive team around me, that none of this would be possible without them. And but at the same time, I've made some missteps there, and I would say I've never once thought that I should have waited a day longer to get rid of someone that wasn't a good fit. And it's not personal, but it's just if someone's not a good fit, better to move along faster than not. And then I'd say like one sort of generic piece of advice that I always give is never trust your gut when it's positive. Always trust it when it's negative.
Right.
That one has definitely served me well in the in this whole journey.
Yeah, and I didn't want to be rude, and I was just going to ask you. So thank you for telling me. When you had said that you're 36 years old, at first when we got on the call, I was like, gosh, this is a young chap here. Good for you, by the way. That is fantastic.
Yeah, thanks. I mean, I pinch myself every day that I get to wake up and do this job, and I feel very lucky. I feel like I mean, I would imagine that there are other CEOs who will listen to this who understand the concept of imposter syndrome. It's like I have it in spades all the time because I'm a young guy in a big industry with a lot of really smart people around. We've had some success for sure, but like there's still so much farther to go, and there's still so much that that I need to learn, frankly. So, yeah.
Right. And you know what? I can tell you this here. What you had said about, the emotional decision to let somebody go that's not going to be a good part of the team, or, that you're having challenges with. I mean, I know it all too well. And, there's been times as well that, there's been individuals at our organization that, and I hate to say this, but, the team you start with is often not the team that you're going to end with. Right.
100%.
And you have to realize that, some of the individuals and that you've made personal connections with and that you've worked with for several years, but you get stuck at a certain size in your organization where, that, no matter what, that individual, just doesn't have the experience to take you to that next level. Right. And, oftentimes you have to top grade that. You're going to have to top grade your staff at some point. And, that's, one of the most hardest things to do in an organization. So
100%. I mean, yeah, it's a really, that's probably the hardest part of the job is frankly changing the team out. And when you're growing as fast as we are, the time cycles get compressed, right? And so like the team that you have at the beginning of the year is rarely going to be the team that you have at the end of the year. And so, and as you get more mature, that the time cycle is extended. But certainly in the early days, your sort of MVP team that like patched the first web page together is not, that team rarely will scale. Frankly, it's an interesting thing. Like the CEO job is the only job where you're allowed to hire people more experienced than you uh,
Oh,
to work for you, right? If you're like a VP of marketing, you can't go hire a CMO,
right.
to work underneath you, right? So it's like you have to naturally sort of upskill. But one piece of advice I got very early on, which I've really tried to live up to, is that as a CEO, like your fiduciary duty and your job is to do what's best for the company. And the second most important thing is that you treat your people as fairly as possible. And like that's, as close a second as you can possibly get. But you can never reverse the order of those two things. And
Yeah.
so if at the end of the day, you have to do what's best for the company. But the way in which you do it matters a lot. And that's doesn't make it any easier, but it's helpful at least to have that sort of mental framing that is the job.
And so let me ask you this: prior to Facet, you were a founding partner of Argyle Ventures, focusing on in investing in startups and emerging tech ecosystems. How has your experience in investment and venture capital influenced your approach to building and leading, Facet Wealth?
I think it's always interesting getting to sit on both sides of the table, right? So as an entrepreneur raising money versus as an investor, getting pitched. And I think that it's like, for me, it's been very, very helpful to have sort of both sets of experiences, because anytime we're building like an annual plan or a budget or something like that, I can always take a step back and say, okay, if I'm an investor and I'm looking at this plan, is this a good plan? Or what are the areas that I don't believe are actually going to happen? What are the areas that, I want to press on more? And so, I think it's always good to have that sort of broad set of views. And so, to the extent that anyone can, I'd always encourage them to spend time thinking about what is learning how the other side works and how the other side thinks. That's been very, very helpful. Most of my investing has been in the very early stages, so sort of pre-revenue, early stage revenue, seed and Series A. So we're a little bit past that at this point, in terms of as far as how fast it goes. But it's the frameworks are all still the same.
Mm-hmm. Thank you. How would you say in a competitive landscape you manage to differentiate Facet against other organizations? You've given us a little bit. You've given us, I would say, a lot in regards to what you guys do that is different from your competitors. You mentioned earlier that there is competition out there. Obviously, competition breeds success. If we didn't have competitors, we wouldn't have anyone to hold the bar above us. So talk to me about that. In this competitive landscape, what do you feel that you guys do differently? Because this has been fast growth you guys have had, right?
Yeah.
I would say remarkable. Ashley and I would say we've done probably close to 100 podcasts. I think there's been one other individual that has had this type of rapid growth. That individual is an influencer as well, but not. I would say not even as quickly as you guys have done it. So, give us a little bit about that.
I mean, I think the number one thing is we're offering a differentiated product in a very underserved and overlooked market. Like we have people who our target market are folks that no one else in the industry really wants to serve, right? Our sort of like average client has a couple $100,000 and earns between $100,000 and $200,000 a year.
Oh, gotcha. That is a real niche market.
Yeah, well, it's niche, but it's also massive. It's 38 million households in the U.S. And
Totally.
so no traditional advisor can service them in the AUM model, right? Nor does their cost structure allow them to do that. And so I think what we've done is basically shown that there's like massive demand for financial advice for this market. So the other thing too is that the type of financial advice that these people want is fundamentally different than what a high net worth person wants. I'll give you like a very specific example. The average high net worth client does their cash flow planning on an annual basis, right? They set aside their budget for the year and they sort of work off that. For the mass affluent, that's a monthly decision process that they have to go through. And so it requires a fundamentally different approach to planning and frankly, a different set of software. Like, the Money Guide Pros and the eMoneys of the world don't actually, they only look at things on an annual basis. And so we had to sort of build software specific to our service in our market. But when I say it's a differentiated service, what I mean is that we have really spent time understanding what our market needs versus what the rest of the industry offers, and sort of match that up. And I think that's the biggest unlock of growth. And then again, like we've got the whole like digital demand gen, and the tactics of how we do it, pretty straightforward. But that I think is the big unlock.
Really cool. Wow. That's brilliant. I that 1 to 200,000, because a lot of people don't even think about investing until they're, at 500,000 to $1 million. Right. So I think that's brilliant.
Yeah. That was kind of the founding premise, right? Is that like there is a huge underserved market that people don't really want to service. Everyone talks about it, but no one's actually done it. And it's not that hard. Like here's the thing: is like there's nothing secret about it. Like we charge differently, and we built tech to be cheap. Like it's pretty straightforward. But everyone's so tied to the AUM based approach that they're not willing to sort of cannibalize their existing business and change how they do things. And that's that just excludes a huge part of the market.
And I love it because you don't really have much concentration risk there.
Totally. Yeah.
Yeah. What's funny is we had a podcast with an RIA. They're managing around $4 billion, 37 clients they had, right? And I was like, wow, if one of those clients leaves, and he said one of the clients holds almost $1 billion. And I was like, wow, if one of those clients leaves, that's like 25% of your book right there. Right. So I get it.
Yeah. It's a fundamentally different model. I mean, we're basically building a consumer technology company, not. It's a different bargain. Yeah. The way that I think about it is we have built Uber Black, right? We've taken a service that is largely reserved for the wealthy and it's very expensive. We've made it more affordable and we've made it better. And that's what our sort of core service is today. That's still, average client pays us $3,000. It's still a considered purchase. It's not cheap. And, I think for us, what's really interesting is like, what is Uber X, right? That's where we're going next. So what can we do for $1,000? What can we do for $500? Again, like there is such a need for financial advice out there from folks that literally can't afford it or can't even get the attention of a traditional advisor. And so, for us, like we want to help, tens of millions of households in the next decade. Really sort of push, across like a much broader swath of the market. We have zero interest in going up market or going to the high net worth. This is such a crowded and saturated space, and we can do so much good and do so much better for people by expanding with lower cost service offerings. I mean, okay, this is like the buzzword du jour, but like obviously AI is going to play a big role. I will say, like, I don't think that AI is replacing the human anytime soon. I think that the smartest advisors are going to be very targeted in their approach to how they apply AI, and it'll be like very specific efficiencies in their processes, and not like AI. I'm just going to replace my planning approach with AI. Like it's going to be like, I'll give you an example of how we use it. It's not sexy, but it's very effective. Which is we obviously record all our calls. We then use AI to like look at the transcript, the sum total of any one client's calls, and build a half-page client summary. And so anyone who interacts with that client facet now has sort of the 5 bullet points on who they are, what they came to us for, what we've done for them, how those recommendations have done, anything else that sort of needs to know. Like I said, it's not super sexy. It's like a very sort of back-end process thing, but it massively increases efficiency because now the long notes, you have one sort of consistent set of information across all of the clients, so no matter who looks at it, you get one sort of consistent thing, and it makes the client experience that much better. So that's definitely, I think, a big one. But there's a lot of cool innovation out there.
So when you talking about AI, right, and the bots and whatnot, how do you guys implement artificial technology into artificial intelligence, I should say, into Facet?
Yeah, I mean that example I just gave around, around the sort of call transcripts and the member summary, that's a big one.
Oh, gotcha.
We, yeah, yeah, that's
I
all
didn't
AI.
know that
That's
was specific towards your firm. I thought you were making a general statement there, so I
no,
apologize.
like that is live. We do that today, and we also have, we have about 14,000 households that we work with, and we have 8 years of financial planning data associated with each one of those. So, we have started to build some pretty interesting models off of that. We have an internal tool we call Facet GPT, where you can basically ask it a financial planning question and it spits an answer back. That's not quite ready for us to release it to the market overall, but like that's coming for sure.
Well, let me ask you this. So, there when you touched on tech, you touched on tech. So, I think what was it in 2022? I mean, we saw Facebook go down to $100 or $80 or something like that, right? And then it's it's 5-6x in value since then. And with that being said, there's companies like Nvidia, companies like Facebook, companies like I think it's SMCI, that have just that hone in on AI, and they have just exploded in value, right?
Yeah.
But there's other companies like DocuSign and Zoom and companies like that haven't that they haven't really their values are kind of at a almost not all-time lows, but they're not doing so swell, right? Do you think that those more mid-cap tech companies are going to follow the bigger guys, or what do you think is going to happen there?
Um, Hard to, I mean, honestly, it's hard to know. There's a lot of like interest rate sensitivity, obviously, with some of those companies. And so, I think it seems likely that interest rates will start coming down before too long. To what extent, who knows? But, you could sort of expect that when that happens, cost of capital is going down, the risk-free rate's going down. So like, those stocks will get a bump. Um, I honestly, I don't really know for the names that you mentioned, like how they're doing from an earnings perspective. Um, but it does seem like there's certainly, some good buys out there. Like I don't see DocuSign going up anywhere anytime soon. Same with Zoom. I mean, obviously, like I think that some of the sort of mid-pandemic highs are probably not ever coming back.
Right.
I think you did have some bubbles going on then, and a company like Zoom is an interesting one where it's like, okay, we all thought that virtual work was here forever, and now that's largely sort of reverted to I think hybrid is the answer, not in office all the time, but like Zoom will definitely be a player, but it's not like it's not like all work forever. So hard to say.
Yeah, and trust me, I wasn't pinning you on those two stocks. I was just more making a general statement about stocks like those. So let me ask you this: you touched on interest rates. Let's lastly, I wanted to kind of get into what your opinion on the broader outlook of the economy is. Right. So we've had some unprecedented events going on these last several years. You got the 10-year Treasury. Speaking of interest rates, controls car loans, mortgage rates. I believe credit card interest rates as well. I mean that's gone from 0.5% up to 5% at one point. I think it's hanging there at around 4.3 or 4.4 today, if I'm not mistaken. We've doubled the country's debt. How do you see that all playing out over the next several years? Do you think it affects the RIA space?
Oh man, that's a big question.
We won't pin you on it, by the way.
Yeah, yeah. I mean, I guess I look at a few different. I look at it a few different ways. I think that on the one hand, geopolitical uncertainty is higher than it's been in a very long time. Right? I mean, you look back to sort of between now and the end of the Cold War, geopolitical uncertainty is at its highest. I think the outcome of the U.S. presidential election is going to be really interesting. I've heard arguments that Trump getting elected is going to lead to an increase in uncertainty and risk. I've heard arguments that Biden getting reelected is going to lead to an increase in risk. You could, that's a little bit of a toss up. But so the risk is higher, but I think a lot of the big things that people are concerned about probably aren't going to come to pass. I think it's very unlikely that China invades Taiwan. I think if we're going to do that, it would have done already. I think that it's pretty unlikely that we go to war with Iran. You never know, but I certainly do. I think that there's a lot of big uncertainties out there. From a purely economic standpoint, I think that we're probably in a better position than we thought we would be a year ago. I think that, if I sort of had to sum it up, I would say that the economy sort of went through a bunch of different sector recessions. Like there was a tech recession from 2022 to 2023. And there's there's a commercial real estate recession that's likely coming, if not already here. But there's these sort of sector specific recessions that are happening, but they aren't big enough to move the needle on the economy and the market sort of writ large. And I think that so frankly, and again, I keep on that earnings are strong, and so the underlying health of spending is there, and companies are also been pretty thoughtful about rationalizing costs, and so it's as long as the earnings keep up, the market's going to stay strong. There are obviously all sorts of shocks that could happen, and could reverse that. But I am feeling somewhat optimistic about the next few years, but I also think that the sort of zero interest rate expansionary times that we've enjoyed for the last decade or so probably aren't coming back in the same way. Yeah. But I mean, this is just me talking. Who knows?
Well, and let me ask you this: Do you think it's unlike where we were back in 2008, right? Where everybody thought that the world was going to cave in. Me being one of those individuals included, right? So, if we could highlight that, for a moment, do you think it's because most 97% of individuals that were able to qualify for a 2.5-3% interest rate got themselves locked in, so their homes are now an asset, not a liability, right? There's been a shortage of building, and inflation has increased wages, so naturally individuals have gotten their wages increased, but their the largest asset that they have, their mortgage, is fixed, and so that gives them more more income that's that they can deploy out and go shopping on Amazon and whatnot. I mean, would you agree with that? Would you think that most individuals that own homes, they got this very low interest rate, and as I said, wages have gone up and gives them more free cash flow?
I mean, I certainly wouldn't discount that. The question I don't know the answer to is what's the percentage of homes that, or what's the percentage of mortgages that sort of fall in that sub 3% or sub 4% bucket? I don't know if that's 10% or if that's 80%. But I know that anyone who managed to lock in that rate, made the best trade of their life, probably.
Yeah.
And unfortunately, I'm not one of them. I just bought a house and I think it's 6.5%, which pains me, but at least you get a big tax write-off. But I think yeah, you do. There is definitely. I think that I'm sure that is definitely a component. Wages have increased, but prices have increased also too.
Right. That could be a wash.
Yeah. So, but these things also never happen at the same. It's always very disjointed. Wages adjust on a annual basis, but grocery prices adjust sort of in real time. So it's it's all a little bit of a balancing act. Yeah.
Yeah, really cool. I like how you said there. Yeah, I wasn't one of them, and the first thing that you pulled out was the most optimistic view that you could have, which was the bigger tax break. I love that. So, gosh, I really appreciate your insights today, and thank you very much for your time and honors. I appreciate you sharing your insights and experiences with us. It's been incredibly enlightening to hear about your journey, your voyage, and the incredible work that has been done at Facet. Truly a unique firm, and a first for us to hear about a firm like this. And to our listeners, thank you for tuning in to another episode of the What Matters podcast. Stay curious, stay informed, and join us next time as we continue to explore the exciting world of wealth management and financial innovation.